The headline price is telling you metals are expensive, but the spreads are telling you they are scarce, and that ASS the difference between a fad and a regime shift. And right now, there's a very deliberate effort to frame this move as just another panic bid. Because if the market admits this is inflation math, then a lot of portfolios have to rebalance in a hurry. That's the hidden mechanism most people miss. It isn't the candle on your screen, it's what's happening underneath it, how the market is pricing time, delivery, and certainty. And before we're done, I'm going to give you the exact checklist for the next 1 to 2 weeks, the levels that matter. What confirms the thesis, what breaks it, and why metals can catch a bid before a single inflation headline hits your feed. Start with what just happened. Gold didn't inch higher. It ripped through a psychological line the market had been orbiting, and it did it in a way that changes how people hedge. In the last few sessions, we watched gold break above 5,000 an ounce for the first time, with prints reported just over that level and intraday spikes pushing higher. Silver didn't politely follow, it lunged. It's been trading around the triple digits per ounce in late January with big daily ranges that scream one thing. Liquidity is thinner than most people think, and positioning is not comfortable. And that's where the real pressure starts. Because when metals move like this, you're not just watching a commodity rally. You're re-watching a market pricing a future state of money before the data gives anyone permission to say it out loud. Now here is the part that makes people uncomfortable. A lot of smart money needs you to believe the move is emotional instead of structural. They'll say it's geopolitics. They'll say it's a one-off headline. They can all say it's a safety trade that will fade the moment the next CPI print comes in. Not that bad. That story is convenient. It reduces accountability. It tells you you're chasing noise, but the market's behavior is not matching that script. Because if this was just a transient fear spike, the curve would not behave the way it's behaving. And if you don't know what I mean by the curve, that's the next detail that flips the whole setup. Most retail investors watch spot. Some watch a daily chart. A few watch a moving average and call it trend. Professionals watch the curve and the spreads because that's where the stress leaks out first. Futures aren't just a price. Futures are a price plus time, plus financing, plus storage, plus delivery risk. When the world feels stable and inventory is plentiful, the market usually pays you to wait. That's contango. Later contracts priced above near contracts, reflecting carry costs. When something tightens, when available metal in the right place at the right time gets scarce, the curve can invert. Nearby becomes more expensive than deferred. That's backwardation. And backwardation in metals isn't a cute academic term. It's a flare gun. It's the market saying, I need it now, not later. And that SY metals can catch a bid before the inflation data hits, because the curve is where inflation probability, supply timing, and hedging urgency intersect. Here's the simplest way to understand it. Imagine you're an industrial buyer. You don't care about a chart pattern. You care about getting material delivered on schedule, because if you don't, your production line slows, your costs rise, and your quarterly numbers get ugly. If lead times lengthen or if premiums rise, you start paying up for certainty. You might lock in supply, you might front-run procurement. That behavior hits the nearby market first, and it pulls the curve tight. Now imagine you a trader who spins short because inflation is coming down and rates are high, and gold can't go anywhere. If the curve tightens and spot breaks out, your carry assumptions fail. Your margin requirements rise. Your risk manager starts calling, and the forced buying begins. But that's not the part that matters. The part that matters is that all of this can happen before a single official inflation number prints, because it's the distribution of outcomes, not the last data point, that drives positioning. Now, zoom out one notch. This week matters not just because price is moving, but because of the calendar. Markets are not continuous, smooth, perfectly liquid machines. They are human systems with deadlines, month-end rebalancing, option expiries, central bank meetings, treasury auctions, policy statements, the end of a reporting period. When you're close to those edges, you get reflexivity. A small move forces hedges. Those hedges push the move. The push triggers stops. That triggers more hedges. And suddenly what looked contained becomes mechanical. That is why you also often see metals catch a bid ahead of the big data. Funds don't wait for confirmation when their downside is asymmetric. They reposition when the risk of being wrong gets expensive. And right now, the risk of being underhedged to inflation, especially sticky inflation, has re-entered the building. Let's talk about inflation bets for a second, because this is where people get trapped by the wrong mental model. Inflation isn't a single number, it's a regime, it's expectations, it's purchasing power, it's the credibility of the currency relative to real assets over time. Markets trade that through different channels: nominal yields, real yields, the dollar, break-evens, commodities, and yes, metals. And metals don't wait for CPI because CPI is backward-looking. It's a report on what happened, Metals move on what is about to force people's behavior. That's why I keep coming back to the curve, because the curve reflects the cost of time and the value of immediacy. When inflation risk is rising, time gets repriced. When supply chains get nervous, immediacy gets repriced. When institutions need hedges, they buy what's liquid and globally trusted. That's why gold is a macro instrument, not just jewelry in a vault. And that's where the real pressure starts. Now, the hidden detail that reframes the entire story is this. Price is not the only signal. The spread is the signal. When the spot headline prints $5,000, the mainstream conversation becomes emotional. Is it a bubble? Is it fear? But spreads are math. Spreads are logistics. Spreads are constraints. Spreads are what happens when the paper market and the physical reality argue. And the argument gets settled by delivery risk. If nearby contracts are bid relative to deferred, if the cost of borrowing metal changes, if the market is paying up for immediacy, that's not emotion. That's supply timing, financing, and real demand for certainty. And once those forces show up, the price chart becomes a lagging indicator. But that's not the part that matters. The part that matters is what it forces participants to do next. Let's walk through the 5-layer proof stack you should be looking for right now, because one argument is never enough in markets. First layer, the term structure signal. Is the curve tightening? Are nearby months outperforming? Are spreads screaming compared to where they were a few weeks ago? You don't need perfect data feeds to understand the idea. You're watching whether the market is paying up for now versus later. If it is, that's a structural tailwind. Second layer, inventories, but with a critical nuance. Not all inventory is real inventory. In metals, there is a huge difference between reported stocks and deliverable stocks that can actually meet contract specifications and be moved on schedule. Inventory can be sitting in the wrong geography, tied up in financing deals, committed to industrial users, or simply not accessible at the price you think. People see a headline number and assume plenty of supply. Then a delivery window hits, and suddenly the market discovers that what is available is much smaller. That's when spreads blow out. That's when the curve tells the truth. And that's where the real pressure starts. Third layer, physical premiums and on-the-ground symptoms. This is the part retail investors actually can observe if they pay attention. Are premiums rising? Are lead times extending? Are refiners and fabricators talking about throughput constraints? Are certain products available but only if you pay up? When physical tightness shows up, it doesn't always instantly translate into spot price because the paper market can absorb flows for a while. But it changes behavior, it changes hedging, it changes procurement, and it changes how dealers price risk. Because if physical is tight, dealers get conservative. They widen spreads, they reduce balance sheet. And when balance sheet steps back, volatility steps forward. Fourth layer, institutional flows. This is the quiet behavior that turns loud. When gold breaks big levels, it's not just retail excitement. It's allocation math. Gold lives in portfolios as a hedge, as a diversifier, as an insurance policy, and as a credibility trade against fiscal and monetary uncertainty. And once you push through major psychological thresholds, the conversation changes inside institutions. Risk committees stop asking, why own it? And start asking, why are we underweight? Alas, even modest flows become decisive when the market is tight because price is set at the margin. A steady bid is a battering ram in a thin book, and that's not the part that matters. The part that matters is that those flows don't need to be frantic to force higher prices. They just need to be persistent. Fifth layer, positioning and margin pressure. This is where rallies become violent. The most dangerous rallies are the ones fueled by people who want to buy, but have to. Short positions in metals can look rational when the narrative is inflation is cooling, real yields are high. But narratives change fast. When price breaks out and volatility expands, margin requirements rise. That's not optional. If you can't post margin, you reduce exposure. If you're short, reducing exposure means buying back. That buying pushes price higher, which raises margin further, which forces more buying. It's a spiral. And it can happen in days, especially around calendar events when liquidity is thinner than usual. Now, I want to tie this to the macro plumbing because this is where inflation bet shift becomes real. One of the cleanest macro explanations for metal strength is what's happening with real yields and currency confidence. Real yields are what you earn after inflation. When real yields rise, metals often struggle because holding a non-yielding asset becomes less attractive. But here as the twist. Metals can rally even when real yields are not collapsing if the market starts doubting the stability of the monetary regime. If people believe that the solution to debt and deficit stress is financial repression, currency debasement, or policy-driven suppression of real purchasing power, gold becomes less about yield and more about credibility. In late January 2026, you can see the tension. Nominal yields can be elevated, and yet gold can still catch a bid because the market is pricing a different kind of risk. And that's where the real pressure starts. This is why metals often move ahead of data. Inflation prints are one input. Policy expectations are another. Fiscal headlines are another. Geopolitical risk is another. Currency dynamics are another. And institutions don't wait for a backward-looking statistic to rebalance when the forward-looking distribution shifts. They hedge the regime, they hedge the tail. And metals are one of the cleanest ways to do it because they are global, liquid, and not someone else's liability. Now let's talk about the conflict again, because it's important to understand the incentives. If you manage a large portfolio, you're constantly balancing risk budgets. You can't be wrong in a way that gets you fired. Underhedging inflation. When inflation risk is rising is a career risk, but overhedging it too early is also a performance risk. So what do institutions do? They wait for confirmation, then they move in size. That creates a lag. Price moves first, then flows accelerate, then the narrative catches up. And mainstream commentary is often designed to keep viewers calm and inside the existing framework, because admitting a regime shift is destabilizing. But the market doesn't care about comfort. The market cares about clearing prices. And right now, the clearing price is being set by a tug of war between paper leverage and physical reality. The next detail is what flips the whole setup. That detail is options and dealer hedging. You don't need to be an options pro to understand the basic mechanic. When lots of call options exist at certain strike levels, dealers who sold those calls often hedge by buying the underlying as price rises. That's delta hedging. If price approaches a cluster of strikes, hedging activity can accelerate. In some regimes, this dampens moves. In other regimes, especially when the market is near gamma flips, it amplifies moves. The key is whether dealer positioning makes them buyers into strength or sellers into strength. When they're forced buyers, rallies can become self-feeding for a window of time. And in metals, which can be less liquid than mega-cap equities, that effect can feel explosive. That's why you see these sudden vertical moves, these gaps, where did that come from? Candles. Because if one level breaks, the math changes. Dealers hedge, shorts cover, trend followers add, and suddenly the whole market is leaning the same way. Now add the calendar trigger on top. We're near month end. Funds that run balanced portfolios often rebalance. If equities move one way and bonds move another and commodities spike, the month-end rebalance can create mechanical flows. At the same time, macro funds often adjust exposures around central bank meetings. If there's an FOMC meeting in the near window, you get hedging ahead of the statement. People reduce risk. Then, if the statement surprises, even slightly, positioning snaps. And in a market like gold that has already broken a major psychological level, the reaction function changes, because now every dip is watched as a potential retest rather than a failure. That sounds subtle, but it's everything. That's how regimes start. Let's translate all of this into so what, because technical talk without actionable framing is just noise. If the curve is tight, physical signals are firm, and institutional flows are persistent, then dips tend to get absorbed. That doesn't mean straight up. In fact, the more vertical the move, the more likely you get violent pullbacks even if the thesis is correct. Metals are famous for this. They whip around, they spike, they shake out weak hands. And the market loves to use volatility as a weapon. It will run price up, lure in late chasers, then slam it down to trigger panic selling, then resume the trend once the emotional money is gone. That's the psychology trap. And if you don't have a framework, you become liquidity for someone else. So here's your psychology shield. First, separate signal from noise. Signal is the behavior around key zones and the underlying structure, spreads, curve, and reaction to macro catalysts. Noise is a scary headline that causes a 1-hour flush. Second, choose your time horizon before the move happens. If you're trading intraday, you're playing a different game than someone positioning for a multi-week regime shift. Third, respect volatility. Even in a bullish regime, a 3% to 7% pullback in metals can happen fast. In silver, it can be much more. If you're size too large, you'll make emotional decisions. That's not a moral failing. That's physiology. Your nervous system doesn't like drawdowns. So manage size like a professional, small enough that you can think. Now, let's address the bearish case cleanly, because credibility comes from acknowledging what can break you. The bearish case is not gold can't go down. Gold can absolutely dump. Silver can get wrecked. The bearish case is that this move is primarily safe haven panic, and once headlines cool and the dollar stabilizes, the bid fades. Another bearish angle is growth fear. If global demand slows, industrial metals can soften, and that can spill into broader commodity sentiment. Another is liquidity. If equities sell off hard, funds can raise cash by selling winners, including metals. That's real. Forced liquidation is always on the table. And the final bearish angle is policy. If central banks sound decisively hawkish and real yields surge, it can pressure metals. So what invalidates the thesis? It's not one red candle, it's a structural change. If the curve relaxes, if spreads stop signaling tightness, if physical premiums cool, and if rallies start failing at former support zones, that's a warning. If the market goes from buying dips to selling rips, the regime may be shifting back. That's the part you watch, not your feelings in the moment. Now the two-scenario lens for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. Price pulls back toward a prior breakout zone, often a round number or a former consolidation area. Volatility stays elevated, but the sell-off lacks follow-through. Spreads stay firm, the curve stays tight. Buyers show up, price stabilizes, then grinds higher. That's the healthy, professional-looking continuation. It shakes out late leverage without breaking structure. And if that's the path, you'll see it in how the market reacts to data. Bad news doesn't decrater it. Good news lifts it, but not hysterically. The bid is persistent. Scenario 2 is the continuation squeeze and gap risk. That's the path where price doesn't give you the clean retest. It keeps moving because positioning is offside and hedging demand accelerates. You'll see sudden jumps, overnight gaps, and intraday rips that feel like there are no offers. In that scenario, the market is using thin liquidity windows, overnights, weekends, post-statement whips, to reprice quickly. It's dangerous because it punishes both shorts and late longs. Shorts get squeezed, late longs get chopped. Professionals survive by having a plan and not needing the perfect entry. Because if this one level breaks, the math changes. And in squeezes, the perfect entry often never comes. So what do you watch, concretely, starting now? 3 things. First, watch the reaction around key zones on the chart without obsessing over single ticks. Think in bands. For gold, the 5,000 area is now a psychological pivot. Above it, the market treats dips as opportunities until proven otherwise. Below it, you watch whether buyers defend quickly or whether the move turns into a failed breakout. For silver, the psychology is even more extreme because triple digits creates a narrative magnet. Round numbers become battlegrounds. The question isn't, can it dip? It will dip. The question is whether dips are being absorbed with speed and whether the rebound is decisive. If the rebound is lazy and sellers dominate, that's a shift. If the rebound is sharp and spreads stay firm, the trend signal remains intact. Second, watch the curve and the spreads, even indirectly. You don't need institutional terminals to see the concept. Pay attention to commentary about backwardation, tight nearby contracts, and physical constraints. If the market continues paying up for immediacy, that supports the thesis that this is more than a headline spike. If the curve relaxes and time premium returns, it suggests the immediate stress is easing, and that's where the real pressure starts, because easing stress removes the urgency bid. Third, watch the macro reaction function. The dollar and real yields. Not the absolute level in isolation, but how metals react when those variables move. If the dollar firms and gold shrugs, that's strength. If real yields tick up and gold holds, that's resilience. If every uptick in yields causes gold to dump, then the market is still yield-dominated rather than credibility-dominated. And the most important days for this are policy days and data days, because those days reveal positioning. The market shows you what it's leaning on. The next detail is what flips the whole setup. It's not the data itself, it's whether the reaction is asymmetrical. In bullish regimes, bullish catalysts matter more than bearish catalysts. In bearish regimes, bearish catalysts matter more. Watch which one you're in. Now here's the part most people miss about inflation bets shifting. Inflation trades are not always about higher CPI. Sometimes they're about the market realizing that even if inflation prints moderate, the policy response is constrained. Debt levels, fiscal commitments, geopolitical realities, supply chain fragility, these can limit how aggressively policymakers can tighten without breaking something. When the market senses that constraint, it hedges the long-term purchasing power risk. That can send metals higher, even if the next CPI print is fine. Because the bet isn't tomorrow's number. The bet is the regime. That's why you see metals move ahead of data. The market is pre-allocating to a world where money confidence is a variable, not a constant. And yes, there's always talk of suppression, manipulation, and paper games. You don't need conspiracies to explain most of what you're seeing. You just need incentives and market structure. Futures markets allow leverage. Leverage allows large positions. Large positions create vulnerability to margin and volatility. Dealers manage risk dynamically. Funds rebalance mechanically. Physical participants care about timing and delivery. When those forces collide, prices can behave in ways that feel unfair. But it's mostly math and constraints. The people who win consistently aren't the ones screaming about villains. They're the ones tracking mechanisms. They know where forced buying can emerge. They know where liquidity thins. They know what the curve is saying. They know what invalidates the thesis. That's it. So let's put a clean bow on the near-term roadmap. If gold continues to hold above its breakout band around 5,000 and buyers defend pullbacks quickly, the path of least resistance stays higher, with upside zones opening above recent highs as momentum funds and hedgers stay engaged. If gold loses that band and fails to reclaim it on a bounce, if it turns from support into resistance, then you have a warning that this move was more positioning than structure, and you should expect deeper retracements as leverage unwinds. For silver, expect violence either way. If it holds its recent breakout zones and continues printing higher lows despite big daily swings, it can stay in squeeze territory, and squeezes can overshoot any reasonable valuation for longer than you expect. If it breaks back below key round number magnets and rebounds are rejected, the unwind can be sharp because silver is where leverage loves to play. The curve and spreads will tell you which one you're in before the headlines do. And here's your final checklist for next week, the one you should literally keep in your head. 1. Does the market buy dips or sell rips around the big psychological pivots? 2. Does the curve stay tight, implying immediacy is still being bid? 3. Does gold hold up even when the dollar or real yields try to push against it? 4. Do policy statements and data releases produce asymmetric reactions that favor the trend? 5. Are you personally positioned in a way that lets you think clearly if volatility spikes? Because volatility will spike. Price can whip around violently even if the thesis is correct. That's not a bug. That's how the market transfers risk from the impatient to the patient. And if you're still with me here, you're already in the minority. Most people want a one-line prediction and a guaranteed target. That's not how real markets work. The edge is in understanding what forces participants to do before they do it. The edge is in watching the mechanisms, not the vibes. The edge is in knowing what you'll do if you're right and what you'll do if you're wrong before the candle forms. So stay with the crowd that can hold two ideas at once. Metals can be in a bullish regime, and they can still punish you with ugly pullbacks. If you can respect that, you'll stop being emotionally toyed with by every dip and every spike. So here's the clean line. If the curve stays tight, physical signals don't relax, and dips keep getting absorbed above the breakout band, the inflation hedge bid remains alive, before the data, through the data, and sometimes because the data doesn't matter as much as the regime it implies. But if those signals fade, if the market stops paying for immediacy, if support zones fail and can't be reclaimed, if the reaction function flips, then step back and let the unwind do its work. No hero trades, no panic exits, just structure. That's the game this week. Not guessing the next headline, not worshiping a single number, reading what the market is already pricing, then watching the one level that changes the math,